November 18, 2021. Sotheby's auction house in New York. A crowd of art collectors, historians, and financial elite gathered to bid on one of the rarest documents in American history, an original first edition copy of the U.S. Constitution, one of only 13 known to exist in private hands. The starting bid is $10 million. Within minutes, two bidders emerge. One is a cryptocurrency-funded collective called Constitution Deo, representing 17,000 individual contributors who pooled their money in a democratic effort to purchase the document and display it publicly. The other bidder is anonymous, operating through a Sotheby's representative. The price climbs: $20 million, $30 million, $40 million. The crypto collective drops out at $41 million. The anonymous bidder wins with a final price of $43.2 million, the highest amount ever paid for a historical document. Days later, the winner is revealed. Kenneth C. Griffin, founder and CEO of Citadel, one of the world's largest and most secretive hedge funds. A man who made his first million in a Harvard dorm room betting on stocks, who built a $62 billion empire by being smarter and faster than everyone else, who survived the 2008 crisis when giants like Lehman Brothers collapsed, and who now wields influence over American markets, politics, and culture from behind closed doors. But what few people understand is how Griffin did it, how a 19-year-old with no family money and no Wall Street connections became one of the most powerful figures in global finance, how he built a firm that now handles more stock trades than any exchange on earth, how he made billions betting against chaos while his competitors drowned in night, and how the same ruthless intelligence and risk management that made him rich also made him controversial, feared, and increasingly influential in American public life. This is not a story about someone who got lucky. This is a story about someone who understood the mechanics of financial markets better than almost anyone alive, and who weaponized that understanding to build an empire. Kenneth Cordella Griffin was born on October 15, 1968, in Daytona Beach, Florida. His father managed a cable television franchise. His mother worked as a teacher. The family was middle class, financially secure, but not wealthy. There were no Wall Street connections, no family fortune, no trust fund waiting. Griffin's father left when Ken was young, and his mother remarried, eventually settling in Boca Raton. The young Griffin was smart, intensely focused, and obsessed with how things work. By high school, he was already fascinated by economics and finance, reading investment books, and following the stock market. In 1986, Griffin enrolled at Harvard University, intending to study economics and possibly go into business. But something happened during his freshman year that changed everything. It was 1987. The stock market was booming. The Dow Jones had climbed relentlessly for 5 years. Everyone seemed to be making money, and Griffin, reading the financial pages in his dorm room, saw an opportunity. He noticed something interesting. Convertible bonds, which are corporate bonds that can be converted into stock, were often mispriced. The bond market and the stock market were valuing the same underlying asset differently. If you bought the bond and simultaneously shorted the stock in the right proportions, you could lock in a risk-free profit as the prices eventually converged. This is called convertible arbitrage, and in 1987, not many people were doing it. Griffin convinced a few friends and family members to invest. He scraped together about $265,000 in initial capital. Then he did something audacious. He installed a satellite dish on the roof of his Harvard dorm to get real-time stock quotes. This was before the internet, before smartphones, before retail traders had access to anything close to real-time data. Most students were listening to music and going to parties. Griffin was running a hedge fund out of his dorm room, tracking bond prices and stock movements, executing trades through a fax machine. By his sophomore year, he was managing almost $1 million and generating returns of over 40% annually. By the time he graduated in 1989, he had proved something crucial. He could identify market inefficiencies, exploit them with mathematical precision, and manage risk well enough to make consistent profits. He was 20 years old. After graduating, Griffin took a job at a Chicago hedge fund called Glenwood Partners, where he continued trading convertible bonds. But he quickly realized he didn't want to work for someone else. He wanted to build his own firm, with his own strategies, under his own control. In November 1990, at age 22, he founded Citadel with $4.6 million in capital from a wealthy investor named Frank Meyer, who had been impressed by Griffin's Harvard track record. The name Citadel was deliberate. A citadel is a fortress, a stronghold designed to withstand siege. Griffin envisioned building a firm that could survive market crashes, financial panics, and systemic crises. His strategy from the beginning was risk management, not just making profitable trades, but controlling downside exposure so that even when things went wrong, the firm could survive and adapt. This obsession with risk would define Citadel's culture and ultimately enable it to become one of the most successful hedge funds in history. The early years were difficult. Griffin operated out of a small office in Chicago, trading convertible bonds and slowly building his capital base. The 1990s were a volatile period. The savings and loan crisis was still unwinding. The 1997 Asian financial crisis roiled global markets. The 1998 collapse of long-term capital management, a hedge fund run by Nobel Prize-winning economists, nearly triggered a systemic financial meltdown. Many hedge funds blew up during this period. Citadel survived, and more than survived. Griffin's relentless focus on risk management meant that even when trades went wrong, the losses were controlled. The firm never faced an existential crisis. By 2000, Citadel was managing over $3 billion and had become one of the top hedge funds in the world. Griffin had expanded beyond convertible bonds into equities, fixed income, commodities, and quantitative trading strategies. He hired the best mathematicians, physicists, and computer scientists he could find, paying top dollar for talent. Citadel's offices in Chicago became known for their intense culture. Employees worked brutal hours. Performance was ruthlessly evaluated. Griffin himself was known as brilliant, but demanding. Someone who could spot a flawed assumption in seconds, and who had little patience for mistakes. But what really set Citadel apart was its technological edge. While other hedge funds were still relying on human judgment and traditional analysis, Griffin was building a quantitative trading operation powered by algorithms, massive data processing, and lightning-fast execution. Citadel invested hundreds of millions of dollars in technology infrastructure. They built proprietary trading systems that could analyze millions of data points and execute trades in milliseconds. They hired engineers from MIT and Stanford, not just financiers from Wharton or Harvard Business School. This technological advantage became crucial in the 2000s as financial markets became increasingly dominated by speed and data. High-frequency trading firms were beginning to emerge, using powerful computers to execute thousands of trades per second, capturing tiny profit margins on each trade that added up to massive gains over time. Citadel wasn't purely a high-frequency shop, but it incorporated those techniques into its broader strategy. Griffin understood that in modern markets, speed and information processing were as important as financial analysis. Then came 2008, the global financial crisis, the worst economic disaster since the Great Depression. Lehman Brothers, a 158-year-old investment bank, collapsed. Bear Stearns was sold for pennies. I needed a government bailout. The entire financial system teetered on the edge of total meltdown. Credit markets froze. Stock markets plunged. Hedge funds hemorrhaged money as leveraged positions unwound violently. And Citadel nearly died. In September 2008, at the peak of the crisis, Citadel's main hedge fund was down nearly 35% for the year. Investors were panicking. Redemption requests poured in. If Citadel had been forced to sell its positions to meet those redemptions in the middle of a market crash, it would have triggered a death spiral. The firm's survival was suddenly uncertain. Griffin, who had built his entire strategy around risk management, was facing the risk management challenge of his life. He made a series of desperate decisions. First, He imposed gates on redemptions, limiting how much money investors could withdraw. This bought time. Second, he personally injected capital into the fund, putting his own fortune on the line to stabilize the firm. Third, he went to investors and convinced them not to pull out, arguing that the positions Citadel held were fundamentally sound and would recover once markets stabilized. It was the most intense negotiation of his life. Somehow, it worked. The investors stayed. The markets eventually stabilized. And in a stunning reversal, Citadel's fund finished 2008 down only about 8%, far better than most hedge funds, and vastly better than the overall market. By 2009, Citadel was making money again. By 2010, it had fully recovered its losses and then some. Griffin had stared into the abyss and survived. But the crisis taught him something crucial. Diversification wasn't enough. You needed multiple revenue streams, multiple business lines that could offset each other when one failed. So Griffin expanded Citadel beyond just hedge fund investing. He built Citadel Securities, a separate entity focused on market making. Market makers are firms that facilitate trades by buying and selling securities, profiting from the bid-ask spread. It's a different business model from hedge fund investing. It's less about predicting market movements and more about processing massive volumes of trades with tiny margins. Citadel Securities grew explosively. By 2021, it was handling roughly 47% of all retail stock trading in the United States. Think about that. Nearly half of every stock trade made by individual investors on platforms like Robinhood or E-Trade goes through Citadel Securities. The firm executes billions of trades per year, making fractions of a cent on each one. It's not glamorous. It's not exciting, but it's incredibly profitable and remarkably stable. The market-making business also made Griffin extraordinarily influential. When Citadel Securities handles nearly half of all retail trades, it sees order flow that gives it unmatched insight into market dynamics. It knows what retail investors are buying and selling in real time. This information advantage is valuable. Critics argue it creates conflicts of interest. Supporters say it provides liquidity and tighter spreads that benefit everyday investors. The reality is complex. But one thing is certain. Griffin's firms have become essential infrastructure in American capital markets. Griffin also became increasingly involved in politics. He's a major Republican donor, contributing hundreds of millions of dollars to conservative candidates and causes. In the 2022 midterm elections alone, he donated over $50 million, making him one of the largest individual political contributors in the country. He's funded campaigns for governor in Illinois and Florida. He's supported candidates opposed to higher taxes, increased financial regulation, and progressive economic policies. His political influence has made him a controversial figure, particularly on the left, where he's seen as a symbol of billionaire influence over democracy. Then came the Constitution auction. In November 2021, when Griffin outbid Constitution Dow for that original copy of the Constitution, it wasn't just a billionaire flex, it was a statement. Griffin argued that he wanted to ensure the document was preserved properly and displayed publicly. He has since loaned it to museums, but the symbolism was impossible to miss. A hedge fund billionaire who made his fortune through financial markets that many Americans feel are rigged against them, outbidding a democratic collective of 17,000 people for a founding document of American democracy. The irony was thick. Critics saw it as everything wrong with modern capitalism. Concentrated wealth, wielded by an individual who already has more money than he could spend in 10 lifetimes, defeating a grassroots effort funded by thousands of ordinary people. Supporters saw it differently. Griffin had the resources to preserve and share a historical treasure. The crypto collective was amateurish and might not have properly cared for the document. Whichever view you take, the auction revealed something about the world we live in. In 2025, financial power and cultural power are increasingly concentrated in the hands of a small number of individuals who operate largely outside democratic accountability. Griffin's personal life has been as dramatic as his professional success. He's been married 3 times. His second divorce, from Ann D.S. Griffin in 2015, was one of the most expensive in history, reportedly costing him over $1 billion in settlement. He owns some of the most expensive real estate in the world, including a penthouse in New York that cost $238 million in estates in Miami, London, and the Hamptons. He's purchased art worth hundreds of millions, including works by Jasper Johns, Willem de Kooning, and Jackson Pollock. He donated $300 million to Harvard. He's given millions to museums, hospitals, and universities, but his public image remains complicated. To admirers, he's a brilliant entrepreneur who built a firm through intelligence and hard work, who survived crises that destroyed others, and who now uses his wealth philanthropically. To critics, he's a symbol of inequality and concentrated power, someone who profits from market structures that disadvantage ordinary investors, who uses political donations to shape policy in his own interest, and whose wealth is fundamentally extractive rather than productive. The truth, as always, is more nuanced. Griffin built Citadel by identifying inefficiencies and exploiting them. That's not illegal. It's not even necessarily unethical. It's how markets work. But it does raise questions about whether financial markets, as currently structured, serve their core purpose of allocating capital efficiently, or whether they become a playground for sophisticated players to extract wealth from less sophisticated ones. The GameStop saga, in early 2021, brought this tension into sharp focus. When retail investors on Reddit drove GameStop's stock price to absurd heights, Citadel Securities was caught in the middle. The firm provides order execution for Robinhood, the trading app many GameStop buyers use. When Robinhood restricted trading in GameStop, many suspected Citadel had pressured them to protect hedge funds shorting the stock. Congressional hearings followed. Griffin testified, denying any wrongdoing. The episode didn't damage Citadel financially, but it damaged Griffin's public image, cementing his reputation in some quarters as a Wall Street villain. What's often lost in these debates is how exceptional Griffin's achievement actually is. Building a hedge fund is hard. Most fail. Building one that survives multiple financial crises over 3 decades is extraordinarily rare. Doing so while also building a market-making business that dominates retail trading is almost unprecedented. Love him or hate him, Griffin is one of the most successful financial operators of his generation. But success at that level creates its own problems. When you control tens of billions of dollars, when your firms handle half of retail stock trading, when your political donations can swing elections, you're no longer just a market participant. You're a systemic force. And that raises questions about accountability, regulation, and power that markets alone can't answer. Griffin himself seems ambivalent about his public role. He rarely gives interviews. He avoids the spotlight when possible. But he also uses his wealth in highly visible ways, purchasing the Constitution, donating to Harvard, funding political campaigns. It's the paradox of the modern billionaire, seeking privacy while wielding influence that makes privacy impossible. As of 2024, Citadel manages roughly $62 billion across its hedge funds. Citadel Securities generates billions in annual revenue. Griffin's personal fortune is estimated at over $35 billion, making him one of the 50 richest people on Earth. He's 56 years old. He could retire tomorrow and live in unimaginable luxury for the rest of his life, but he shows no signs of slowing down. Citadel continues to expand, hiring aggressively, investing in new strategies, exploring new markets. Why? What drives someone who already has more money than he could possibly spend? Part of it is competition. Griffin is intensely competitive. He wants to win, to be the best, to build the most successful firm. Part of it is intellectual challenge. Financial markets are endlessly complex puzzles, and Griffin is someone who thrives on solving puzzles. Part of it is legacy. He wants Citadel to endure beyond him, to become an institution that lasts generations. But there's also something darker. Success at Griffin's level requires a certain ruthlessness, a willingness to push limits, to exploit every advantage, to outwork and outthink everyone around you. That mentality doesn't turn off. It becomes who you are. And once you've built an empire, the idea of walking away feels like surrender. The Ken Griffin story is still being written. He's not yet 60. Citadel is still growing. His political influence is expanding. His cultural impact through art purchases and philanthropic donations is increasing. Whether history remembers him as a financial genius who made markets more efficient or as a symbol of an era when wealth became dangerously concentrated depends partly on what happens next, both in his life and in the broader economy. But one thing is certain: he represents something fundamental about modern capitalism. We live in an age where intelligence, technology, and access to information can be converted into extraordinary wealth with astonishing speed. Griffin went from a Harvard dorm room to $35 billion in roughly 35 years. That kind of wealth accumulation was almost unthinkable in previous generations. It's routine now among tech founders and financial innovators. The question is whether that's sustainable. Whether an economy that rewards financial engineering as richly as it rewards productive innovation can remain politically and socially stable. Whether markets dominated by algorithmic trading and high-frequency execution still serve their fundamental purpose of connecting capital with productive enterprise. Whether democracy can function when individual billionaires wield as much political influence as millions of ordinary voters combined. Ken Griffin didn't create these problems. He's a product of the system, not its architect. But his success illustrates the system's dynamics perfectly. He identified opportunities, exploited them brilliantly, managed risk better than his competitors, survived when others collapsed, and built enduring institutions. By the rules of the game as currently structured, he won. But if the game itself is broken, if the rules produce outcomes that concentrate power and wealth in ways that undermine the broader social fabric, then Griffin's success becomes evidence of a problem, not a solution. That's the paradox at the heart of his story. The same qualities that made him successful, the same intelligence and drive and ruthlessness, make him emblematic of a system many people increasingly distrust. When he outbid 17,000 people for the Constitution, he wasn't just buying a document. He was, perhaps unintentionally, illustrating the central tension of our age: democracy versus plutocracy, collective action versus individual power, the many versus the one. The Constitution he purchased was written to enshrine popular sovereignty, the idea that power flows from the people. That a single hedge fund manager could outbid tens of thousands of those people for a symbol of their own founding principles is either deeply ironic or perfectly fitting, depending on your view of American capitalism. Griffin will continue making billions. Citadel will continue dominating markets. The debates about his influence and his legacy will continue, but the larger questions his success raises about wealth, power, markets, and democracy are questions every advanced economy must grapple with in the coming decades. We haven't answered them yet. We might not like the answers when we do.